Hello everybody, welcome back to the Tokyo FinTech podcast. This is the second part of our conversation with Carl Ellicott, who's an investor, founder, analyst at Topio Networks, and the author of a comprehensive blockchain ecosystem map that he publishes out every quarter. Here we're going to continue our discussion on identity and authentication, discussing friction and frictionless approaches to financial services and FinTech, and we're discussing resilience in the context of the Robinhood and the MakerDAO difficulties during the flash crash.
Right, and that's why I think you see the two bulked so well together, right? Digital identity and digital authentication. Identity and authentication can go hand in hand. They can be very separate. But your example, I come through Heathrow, they see me as Kyle. But the authentication, the approval to enter fast or slow in the queue or not, that comes from a certain level of authority. And then that has to be approved. Those two things are going to go hand in hand. And you're going to have this layer of, certificates or smart contracts that's going to be so important. And the next part of that is infrastructure, and that goes to speed. It's how you can handle the speed of approvals, the speed of authentication. We've got a very wild, and it could be very exciting. It can also be very scary when you get into new technologies like facial recognition that may play a role into that as well. I think we've probably all read 1984 at this point and others.
And it's very exciting from a Japanese perspective because for a long time, and don't know when it started actually, we have what is called My Number, which is the equivalent of the Social Security number in the US. However, it's not widely used. And when we came back to Japan in 2017, for example, I had to fill in all the HR forms while joining a company. Then the My Number had to go into a separate concealed envelope because it shouldn't be written down on something that everybody can see. And that seems to be changing now. There's OneDrive that is pushing towards cashless payments, which was meant to end at the end of June, just before the Olympics. 9 months of discounts if you pay cashless. And the Interior Ministry, they have an initiative running then from July and August, I believe, where you actually can get a new physical card for My Number, and you can actually dedicate one cashless payment service. And then starting in September, you get 25% discount up to 5,000 yen. So that's like $50. It's not a lot of money, but it's free money. And the Japanese, as anybody else in the world, loves free money. So I think there will be a take-up of these cards, and then you suddenly have a digital foundation where you can build things onto that. It's probably a bit more robust given that it's a more recent development than the Social Security number in the US. It's really exciting to watch to see the adoption.
Well, and to your example, we're in a very unique time, and people say that all the time, but it's truly, right, where we are in this year of 2020, going back to that example of that past decade, the amount of technology that was created, the amount of innovation that happened was so rapid. And the amount of brilliant people, right? People you and I both know, right? Common friends. The amount of brilliant people out there has exponentially grown. And now they're everywhere. So now you've got corporations moving faster in some cases, slower in others. Innovation, almost forward thinking, 10 years out, right? Waiting for everyone else to catch up. And you have all of these pieces that are like, give it to us now. And some pieces of it are being implemented over time, right? Your example of Japan, you're ready to go. You are ready to be in this future we've talked about for the past hour. You're ready for this, but it has to catch up. The innovation, the technology in some cases is there, some is not. So that's why we're in this interesting time because it's disproportioned, right? We've got all the smart people. We've got a ton of innovation that happened in 10 years, which gave us this desire or this demand almost like we should have this, we should have this, we should have that. We only have part of it. And so now it needs to come together and form that one block, right? That one piece, no pun intended, but needs to come together to make it all a reality. And I think that's what makes this year so exciting on all levels. And a lot of what I'm seeing on the blockchain at the infrastructure level and, DApps and DeFi is just everyone wants this now. Everyone's excited, moving what feels like 10 times the speed of light. We're going to get there. We have a few more pieces to get in place, but we're really going to get there. It's going to probably go faster. It will go faster than what we saw in the last 10 years. That last 10 years, a lot happened. In this next decade, again, just using this as a time reference, we may see similar progressions in 3 years.
Exactly. And so this is entirely funny because in the face of the current crisis, and we talked about this before we got on here, I'm probably more on the calmer side, right? We're not in the risk group. We don't have kids. Mom is safe. And so this will stay with us not for 2 weeks. It will stay for us into 2021, if you ask me. But it's a topic where I shouldn't be trusted to come back to your earlier point, because anybody can say that, right? In any case, I'm relatively quiet. And what you get to hear from most people is like, well, you don't understand exponential curves. So if this goes on for like the next year, right, know where we end up. And it's like, dude, I'm a technologist. I understand exponential curves. With what you describe, this exponential innovation that we've seen, taking it back to the invention of the microprocessor, really, what hasn't really matched up is our ability as humanity to understand that. And so we're progressing linearly on our understanding. Technology continues progressing exponentially. And so this gap is going to increase and increase. There's no way out of that.
No. And maybe there is one day a big bang, right? And it does all come in it forms for the most part, right? 80% of it just clicks, but it may not. And part of that's okay, right? And it's due to the fact of how we are more globalized than we've ever been. We look at things on a much broader, bigger scale globally than we do locally. And go back 20 years, that wasn't the case. Now we do. And thanks in part to the internet and all this other innovation and technology that has brought us closer together or connected when apart, like what we're doing right now. We're not on the same page in any respect. Where and how we move and the way that we change things in our life so quickly, it's just going to continue to happen. Go back to that point we made about so many getting into the world of FinTech or financial technologies and pushing that forward. You could start to see a leveling in some cases where bigger companies that are globally known, people are using. Again, using the basic examples of like WeChat and WhatsApp and Square and a handful of others, those are global companies that interchangeably TransferWise is another. People are using these globally because they lived in London and then moved to Hong Kong, and then from Hong Kong moved to Miami, and from Miami moved to Sydney, right? And so they brought that technology with them and then started to grow it locally in the new area that they moved to. And again, I think that just goes to how globalized we are. And some of that's for the great, some of it's not so great, widening that curve. Some of it's great because people like yourself and others are moving around to new places and helping to build those local ecosystems and bring new technologies and new ideas and challenges to those reasons. That's what China and Asia did for me, was open my mind up to this world of FinTech and open finance where we're going, showing me that there was something different. Not that I hadn't read it or I hadn't studied it, but actually using it and integrating it into my daily life and it becoming commonplace. That was Asia. And so it just goes to show you again, back to that point of we're just so globalized as a society today that, and we're very fortunate to be, that a lot of this tech just is going to kind of come and go and evolve in certain areas and take longer in others.
That's one topic dear to my heart I want to talk about. That's friction and frictionless. Yeah. And you wanted to talk a bit more about corporations. For me, it's like the dark side of frictionless. Right? Clearly, there is a financial system that is hard to handle at times. And 99% of fintechs are focused on removing that friction. Now, when you make something easily accessible, there's always a part of the population that can't handle it well. And for me, it's chocolate. Leave chocolate within my daily radius, it's gone. And so I've got this mechanism that's called my wife, that when we get a bunch of chocolate, hides them. I can get my weekly allocation of a bar of chocolate. Otherwise, I would be able to fill the whole screen. Friction is actually a good thing for my health. And similarly, financial health, that people, if they gambling habits, whatever else it might be, if you give them a bunch of money digitally and you give them a frictionless way to spend it within milliseconds, they will use it. But their rent will come due on Saturday. And so what I find interesting is it's like this herd mentality, right? Everybody's talking frictionless. So everybody's moving to frictionless. And now these outliers, these out-of-the-box thinkers who say, actually, for the most part of the population, that's great, but there's a segment, and that is still a valuable segment, where actually reintroducing friction is a good point. One company is squirrel in the UK, they custody your money for you. Not very efficient in the initial implementation because they use a separate bank account. But you get your salary transferred into a separate bank account, and then it transferred into your real bank account like a day before you need to pay your rent. It's like the equivalent of hiding chocolate. Financial health in that sense is a serious problem again, and not all frictionless is good and not all friction is bad. That's the point, basically.
Yeah, and I couldn't agree more, both on the chocolate example, which I have a similar problem with, and the primary example as well is, as consumers, there are certain frictions, yes, that make sense. Squirrel and Venmo and a handful of others provide a frictionless experience that just makes sense. On a broader scale, or general scale, consumers globally, it's a mindset where certain frictions we're not ready yet to have those removed because we may or may not be disciplined enough. We may not have an understanding. It may be too loose. That's worrisome. Like the idea today of everyone being their own bank. I love it. I think it's a great statement. I think it has many definitions. In its most general statement of everyone now controlling everything, that's terrifying because, to your point, without that friction of having to go to the bank, someone may lose all their money. And some people may say, well, that's what should happen. Well, that's not for us as technologists to decide. We should be able to build in certain features to make the experience overall beneficial for everybody. And those who may lack the discipline, they have to still go through the steps, and that's still going to happen. But those who have the discipline, let's continue to improve things for them. So I agree, some frictionless is very exciting, but it's very terrifying. Again, go back to that education example. We're not educated there yet. So the idea of everyone being their own bank, again, I believe it. I love it. I think it's a great statement. It will come. It will have its time. When are we going to get there? TBD. Not sure. Will we get there in steps? Absolutely. And will we see discipline start to come into our minds and lessons learned? Absolutely. Right? The first time you made a mistake on Venmo, as an example, accidentally sent someone $10, couldn't get that $10 back because it was the wrong person, you lost $10. You hopefully didn't make that mistake again, or you double check. Right? The same thing will happen as we remove those frictions throughout our daily lives. It's just we can't take them all out at once. That would crush the system and it would crush people. But will we get there? Yes. And what else may become frictionless? We'll see, right? The lending process to the types of assets we hold, it's coming. It's just pieces. And it's the other way to think about this, so frictionless, the amount of added weight and pressure that puts on you, right? We already have enough to deal with in the world. You go 9 to 5 from work, that's a lot. You got people, you have family, kids, friends, social, corporate lives. You have all this stuff already to worry about in a day-to-day. Now you have to worry about protecting a collection of assets that are digitized. That can be incredibly stressful for people day one. But if you start to tease this stuff in, right, and you let people build this habit, right, this mindset of how to manage these things, it can be a lot easier. But yeah, frictionless is great and slightly terrifying all at once. But just to be clear, I believe that's coming. I believe everyone being their own bank is going to happen. How and when, those pieces are still coming together. Will everyone have their own art gallery they manage? Maybe. It's just going to take time, but there will be some friction, and some people may choose to keep that friction. Others may say, like, I want it gone. You and I today may say, give me my frictionless experience tomorrow. I'm ready. And you know what? As technologists and innovators as we are, we'd probably panic. We'd probably just break it down because you'd have to realize what you manage, how to handle everything, and what that means. Ryan Adams, who runs Bankless, right, and Cami at the Defiant talk a lot about this world of open banking or open finance and Bankless, right, and everyone being their own bank. They do such a good job of teeing up these tutorials and walking you through these processes. But when you really think about that, all of these pieces, it's a lot to manage. And Ryan at Bankless does this great series on future of work and he did an article about the future of work and all the pieces that encompass it and kind of the Web3 equivalents. That is a lot to manage, right? So if you're a client of mine and someone else is a client of mine and what you're paying me through my bank account, but then someone else is paying me through a digital currency, and I have to manage 2 different commerce transactions, and then I have an e-commerce store that's taking in commerce. I mean, there's all that just there, right? And now I've got employees that I have to manage maybe 2 different HR systems or one. The point is, there's so much to be excited for around this frictionless world, the future of everything, the future future of work, the future of transportation, the future of finance, the future of everything we do is so incredibly exciting, but there is a little bit of underlining terrifying feeling and shakiness that comes with it. It's a lot more responsibility. And while we love things to be frictionless, we also love less responsibility. Will there be a world where, go back to identity, that through identity, we have a more centralized way of managing some of these things? So while they're frictionless in their own right, we have less of a burden, because it kind of is, when it comes to responsibility to manage those. That's possible. But again, the future of all of this and the lowering of friction absolutely is coming, and I'm incredibly excited to watch it further evolve.
Function by function, frictionless is good, but then in aggregate, when I put it together, the sum of all frictionless can create additional friction because it's hard to manage, and I actually need some centralization again on top because I don't want to manage 10 HR systems.
Our generation, respectfully, will go through the bumps and grinds of this, right? We're going to see more of this. We're also going to be the loudest voices in the room, challenging and pushing this. The generation that's growing and coming of age and being born today, that's the generation that this will be commonplace for. Where there's a middle generation where, the internet, they didn't know anything but the internet, right? The next generation will know nothing more than just the open world of finance. It will just be simple. For us, that is a frictionless battle where you remove all the friction, we panic. We get excited, but then we panic when we realize maybe what it may incur. It'll make good in some ways and make bad in others. And like you said, it will actually add friction in different ways. And that's okay. I mean, that's our job. That's our job right now as innovators, is to figure out what is friction, where can friction be removed, and how can we improve those areas to lessen the friction. And again, that's why I'm so excited about, open finance. I'm excited about the world of decentralization that we have in front of us, because we get to be the ones to lay out the pavement. And that's exciting.
Let's do the corporations in a little more detail. I think we touched upon maybe two aspects of that already. One is the branding, the trust that you have in a brand. We mentioned JP Morgan has been around for quite a while. And the other is maybe a bit of a stretch, but also goes to the regionality and the development of financial systems, right? I think it's always easier to build something new where you don't have something than trying to overcome existing institutions. And I've been at Goldman a long time, which obviously has been an investment bank catering to institutional clients for the longest time, and then started to building Marcus, which is a great success story for going into a retail market and gets now replicated from the US to the UK. Again, building something from scratch where you don't have anything and you can apply the latest technology. You don't have to deal with legacy system connectivity and the mainframe that's still written in assembler. Man, every technologist would love to do that, right? It's a great opportunity. So I think on the corporate side, it's similar. There are players who don't have the legacy infrastructure, and right, there might well be there commercial banks who go into the retail space, or there might be entertainment companies that using their built-in customer base for additional services. But you've thought much more about this. This was, I think, just a recap of what we mentioned already.
I think we've already started seeing this in the last few years, and we're going to see it very aggressively in the next 3 to 5, maybe even in the next 2. You're going to see much more innovation around the products and services that corporates offer, enterprises offer, that focus on this world of transaction, because they do, like you said, they have an inherent user base, right? So someone like an entertainment business, we'll just say like AMC Theaters, right? AMC Theaters has 1 million customers. They know that they have these 1 million customers that subscribe, that have their membership, that have everything. There's no reason they can't create a financial infrastructure to engage with them, right? To make an additional revenue line for them, but make a new product offering for their customers. In the same respect, what I think will happen in the next couple of years is you're going to see more M&A than we have in a long time, and specifically in this sector, right? Where a company is going to want to get into the payments, banking, transaction, whatever it may be, custody. They're going to want to get into that. So they are going to start scooping things up, because some of the greatest minds have gone to build these companies, and it will be easier to scoop and acquire than it will be to try to build this internally with legacy systems. For any of those of us who have worked in an established corporation, they're wonderful. But when you try to introduce new technology or new innovation, you hit roadblock after roadblock after roadblock, and some of that can can't be avoided because of legacy. If you can acquire that business, and you mentioned Goldman, we've seen what they did and what they've onboarded, offboarded, you can move a lot faster. So I think, yes, on the enterprise side, we've got more companies that are talking about getting into financial technology or improving it. We've got more companies that will start to do M&A aggressively in the next 2 years, but for sure over the next 3 to 5. And corporate venture arms are already starting to cherry pick. Can't remember the exact stat, but I mean, the amount of venture funding that went into FinTech alone, right? We're not talking anything decentralized, blockchain. We're talking FinTech alone. I mean, that was an enormous amount of money. The acquisitions we're starting to see in that plus blockchain, decentralized, is increasing month over month. Double-digit billions of dollars that has been invested in just the blockchain space in the past 10 years. The last number I had, I think, was just around 22 plus billion in the past 10 years. That's a lot of money. My expectation is you're going to see more venture capital and more investments, more M&A into financial technology focused on this future of whatever it may be in their respected industry, and then also more around FinTech.
I mean, if you look at the comparison with other industries, it almost sounds like the new normal for banking is what pharmaceuticals used to be up to this point. Because on the one side, you have this aggregation, you've got these mergers, all the big companies. It also means that innovation inside slowed down, and the really fascinating, innovative new drugs, they come like from startups. So obviously, then to bring the drug to market, need funding, and then they get acquired at some point.
Yeah, right. So you have someone maybe that worked in finance, just keeping that example, right? That may have worked in a particular finance in a particular industry, left, saw the problem, came together with other bright minds and said, let's fix this, builds it, grows it, gets investment, scales it, goes back to the corporate or corporates, gets more funding, or gets and continues to build and or gets acquired and brought back in. You can easily see that, right? And more companies now than ever have internal venture programs. They have labs, they have their own accelerators, and they have their own entrepreneur in residence programs to focus on these types of things, to try to do this in-house, smarter, faster, cheaper, at the end of the day. And some will succeed, others will not. And that's just the way it is. And it's going to be exciting. But yeah, the blueprint's going to be the same.
Now, obviously, we have hundreds of years of making mistakes in financial services. And some of these lessons have been learned, some of these haven't. Also, at times feels, when you look at the FinTech or the DeFi space, there is a certain level of arrogance, I would almost say, in that we know it all better. You old guys have no clue. And then you get into things like Robinhood shutting down for how many days and not giving access to the customers during some of the worst trading days. In a way, MakerDAO had a lucky escape, $4 million lost at the end of the day, refilled through Maker token auction. You don't need a rocket scientist to say that in a distressed market or in a high volatility market, you get more customer activity. What is your plan, Robinhood? And clearly they weren't prepared in any way for the onslaught of customers that were suddenly trying to get their trades done.
With those particular examples, one of the things that happened with the Robinhood example, which is good, is just scalability. Consumer demand is starting to grow in areas that maybe it wasn't. And then Robinhood was created out of that. More people wanted access to public markets, but didn't want to go through opening up a traditional account, paying the fees, the high minimums, etc. So Robinhood gets it created. And then more people on board. Robinhood introduces new features, starts to grow, starts to scale, maybe gets a little shaky behind the scenes in terms of their infrastructure, but they are able to keep up with the growth. And then comes, we'll just refer to it as the Black Swan event, which challenges the entire infrastructure that it was built on. They, nor many others, were ready for such an influx. Most of that is just because it's not common, right? If you have 1,000 users, you don't expect all 1,000 users to be on the same thing at the same time. You expect maybe, 10, 15, 20 growing percentage, but you don't expect 100%. Well, in this particular case, it happened. Everyone surged the platform. We saw this with other companies as well. And now there's a challenges in the market is infrastructure needs to be better apt to scale. And that's where the idea of edge and distributed compute come in, is how can we rapidly scale our processing capability or our ability to handle this kind of load in a faster way, right? So that we don't go down for 18 hours on the second worst trading trading day. We don't go down for a full day on the worst trading day, but instead, maybe we have a small snag and a little slowness for the first hour, and then we're fine. That is, I think, a hard lesson, that painful, expensive lesson everyone learned very quickly. And even with Maker, the same thing, right? You get your entire, we'll just continue to use the word platform, you get your entire platform surged with 80, 90, 100% people want out. People want to be active. You're not ready for that. And so the applications of the future and looking at Web3, that's a hard lesson to take to heart. If you're building an app right now, decentralized or otherwise, you need to be prepared as you grow and scale for that fluctuation. Because if you have something that people want, and to our conversation, it's tied to finance, it's tied to people's money, that's something they need instant access to right away, no questions asked. And you have to almost do stress tests. And we're seeing more of this, right, in the DeFi, decentralized finance spot, right? When more people are trying to do audits, trying to do stress tests, because you need to be ready at every time. So if you have 100 users today, your system should be able to handle, call it 150%. And if it can't, why, right? What more is it going to be? What more do you need to do to scale it there, right? If you've got 110%, know what the risk you're running, right? If you're at 70%, know that you are in trouble. And that's a lot of what Maker came out of looking at is, we need to reassess. And a lot of other stable coins, a lot of other platforms in the DeFi space, just like we had with the flash loan attacks, people realize like things have to be stress tests. Things have to be, you can't run 100 miles an hour, go all the time and not check things. And that's just part of the testing, the Q&A process, part of developing something new, right? Something that's challenging. We are learning from those experiences. And I think you're going to see new types of challenges arise from those, but some of those things will be forethought out before.
In today's world, going to AWS and scaling up a 5,000 server farm on a spot for a quant calculation that only runs 40 seconds but needs that horizontal scaling is snap and it's not very costly. So, Robinhood should be severely punished and penalized in the same way the banks have been after the financial crisis, because I don't think they have any excuse for that breakdown and the way that went down.
I think I've read that they will be. There's going to be some stuff that's going to come out, but I don't disagree. And I think what we can all take, right, including all the listeners here, what we can all take from these situations is it's important to just take a minute and actually do the checks and balances. Take the time to stress test and go through QA constantly. And it's going to be even ever important as we get into this world of decentralization to have those habits, those processes in place, that you're constantly checking these things. From what I take away, that's the biggest piece. Is it's more important than ever to have those checks and balances in place, because if you don't, this is what happens. You're not just down and I can't post an update. You're down and I can't access my capital, or I lose 70% of the capital I had with you without any chance to get it back. Now, speaking general, right, there are things in place to protect that, but just as the extreme is you're dealing with something that's a little bit more emotionally attached to people and their lives are dependent on it. And when we look at the world of open finance and just decentralized finance, that is still in that world. Therefore, we need to take those precautions to do the audits, to do the tests, to continually look at how we can grow and improve scale and how we can improve timing to just keep things going. Every industry goes through this. Every industry, as you and I both know. Look at domains. Domain names have a 99.9% uptime. The reason that got put in is because at one point they probably promised 100% and then something got hacked. Their system went down, your system went down, whatever. There was a hack. Because of that, there was downtime. You could then challenge the 100% and get your money back. Well, now with 99.9, there's that fraction of error of uptime. More likely it's never going to occur, but there's a fraction of it. And so we need to take, again, this away is that everyone goes through this. It's very unfortunate what happened when it happened. Now going for Web3 in the future, take this into consideration and don't make the same mistakes. Hopefully the others that you make are less impactful than those that came before.
You mentioned the flash loan. What a brilliant mind. 3 distinct protocols and all of them run in isolation perfectly, and figuring out how to combine them and exploit this. It's totally worth the $400,000. That should be the hacker bounty anyway, but that really needed a smart mind to figure it out. Clearly, otherwise it would have happened much earlier.
It was 2 attacks, so just over 300 and then just over 600. So just around $1 million, we'll call it. Yeah, it's a lot of money. That's a lot of money, right? But it was going to happen at some point. Could have been hacked to everyone's accounts and deleted everyone's accounts, right? That's another way of looking at it. Instead, the individual found a very clear as day flaw in the process, and it was there. And now people know about it, and now people can test against it and try to build new safeguards against how those types of things work, right? Maybe loans now, and from that perspective, are more time-based, right? There's a restriction on time versus instantaneous. They give half a second or a millisecond of delay. So there, at any point, people will find a way to challenge, to test, to break, to game, whatever the system. That's never going to change. That was a very loud example for the world of DeFi and open finances. This is great, but when it comes to these applications, like know what's open and what's not. And I can tell you from those I've talked to, those I've worked with, those I advise, I've invested in, whatever, this has not gone away in terms of conversation at the table. This is constantly being talked about, which is good. Not good for whom it happened to, but it's good that people are taking that on a serious tone as an industry. And I'd argue that's one thing that's very beneficial about this world that we're looking at is the community in some cases talks so much that and moves so quickly in collaboration than any other, right? So as the moment that type of thing happened, you had tons of people working on it, trying to figure out what happened, talking about it. Same with Maker, right? And same with others. Everyone's trying to help out. Even competitors were jumping in to help and support. Some were banking off of it, but others were trying to jump in and help and support. In traditional industries, you haven't seen that. So I think that's another very, very unique perspective of that. It cost $1 million. Think of it as a very expensive seed round of investment and or debt.
Again, I've got a whole lot of respect for the person who figured that out. I think it's not something that was that obvious, and clearly $1 million is a lot of money, but we want this infrastructure to support billions, if not trillions, at the end of the day. So it's a small investment made into people being more thoughtful, more testing, more robust infrastructure. It happened in an unfortunate way, but a series of academic conferences and paper reviews would not have revealed the same thing.
That's what innovation does every day. Challenges the old and makes way for the new. And sometimes it's costly, sometimes it's not. But in any case, something exciting and better comes out on the other end.
Exactly. Super. I think that's a good way to end this conversation. Thank you, Carl. I've taken so much of your time.
No, good.
Our listeners will appreciate your insights. Thank you.
No,